Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024, May-June, Paper 2-3, question number 1. This is paper 2, which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit for this paper is 1 hour and 45 minutes. Since question number 1 is of 30 marks, ideally you should be spending about 35 minutes in order to solve this question. And in this video as well, we'll be attempting to solve this question under 35 minutes. So without any further delay, let's get started. K Limited provided the following extract from the company's draft statement of profit or loss for the year ended 31st December 2023. We have been given the revenue, the cost of sales, and the gross profit. It has now been discovered that adjustments are required for the following. Opening inventory at 1st January 2023 had been understated by 14,000. Sales returns of 8,600 had been deducted from purchases. Closing inventory at 31st December 2023 included 40 damaged items costing 30 each. It is estimated that after repairs costing a total of 420, the items could be sold for 38 each. Alright, so for the closing inventory, we can first calculate the cost. There were 40 damaged items costing 30 each. So the cost of these damaged items would be 40 times 30, which results in the value of 1200. Now we know that it would also require repairs, after which they could be sold for 38 each. So we can calculate the net realizable value. That is just going to be the new selling price, which is 40 times 38, minus any repairs cost, which in this case is 420. So this will result the net realizable value to be 1100. And we always know that inventory should be valued at the lower of its cost and net realizable value. In this case, it should be valued at 1100 instead of 1200. So we can say that the closing inventory is overstated by 100 because it should have been 1100, but we included it at 1200. Let's take a look at the first part. We need to explain the accounting concept which is applied to the valuation of damaged inventory. We always apply the prudence concept. And it states that inventory should be valued at the lower of cost and net realizable value so that assets and profits are not overstated. That is all for the first part. Let's move towards the next one. We now have to calculate the revised gross profit for the year ended 31st December 2023. In order to calculate the revised gross profit, let us start with the draft gross profit. Which is given above to be 377,500. Now, let us first rectify the first error. The opening inventory had been understated by 14,000. So we need to add it to the opening inventory. And we know that opening inventory is subtracted as part of the cost of sales in order to get the gross profit. It means that in order to get the gross profit, we always subtract the opening inventory. And in this case as well, we will be subtracting this amount of 14,000 as opening inventory understated. So we can start with the opening inventory understated by the amount of 14,000. That is all for the first error. Now for the second one, sales returns of 8,600 had been deducted from purchases. Firstly, we have to subtract this 8,600 as part of the sales returns, right? Now, it had been deducted from purchases, so we have to rectify that. So we have to add it back to the purchases, and we know that purchases is also subtracted as part of the cost of sales to get the gross profit. It means that we again have to subtract this 8,600 in order to get the correct value for the purchases. So that will be another minus 8,600. So in total, we'll have to subtract 17,200 in order to rectify the second error. So that is our error regarding sales returns. where we subtract 17,200. Alright, then for the third one, we have already calculated that the closing inventory is overstated by 100. So we need to subtract it, and also remember that the closing inventory itself is subtracted as part of the cost of sales. Then the cost of sales itself is also subtracted when calculating the gross profit. So we have three negatives which will result in a negative. It means that we just need to subtract this 100 in order to correct the third error. So that will be our closing inventory overstated by 100. Now we can get our revised gross profit. So that is just going to be 377,500 minus 14,000 minus 17,200 minus 100, which results in 346,200. That is all for the second part. And we have been given the working section. So you need to show your workings for this part and your workings for the cost and net realizable value within the working section so that you get your markings correctly. Let's move towards the third part now. We have been given the additional information at 1st January 2023. We have the debenture, property at valuation, plant and equipment, retained earnings, revaluation reserve, share capital, and share premium. Now, during the year ended 31st December 2023, the following payments have been made. There was payment for administrative expenses, debenture interest, distribution costs, dividends, and we purchased a new equipment at the date of 1st April 2023. Okay. Plant and equipment is depreciated by 20% per annum using the straight line method on a month-by-month basis, and the depreciation should be allocated to administrative expenses 60% and distribution costs 40%. And since we have a month-by-month basis, we need to calculate it separately. We need to calculate the depreciation for the existing plant and equipment for the entire year. And for this new purchased one, it was purchased on 1st April. So we used it for the months of April, May, June, July, August, September, October, November, and December. That will be a total of 9 months. So for this one, we need to calculate the depreciation for 9 months. Let's do that. Depreciation on plant and equipment is just going to be 160,000, which was the existing plant and equipment. So 160,000 times 20%, plus for this 20,000, that will be times 20%, but we only use it for the 9 months. So times 9 by 12. This results in the total depreciation of 35,000. Now we need to divide it 60% and 40%. So 60% of 35,000 is 21,000 and 40% of 35,000 is 14,000. So this 21,000 should be included as part of the administrative expenses, and this 14,000 should be included as part of the distribution costs. Alright, then distribution costs includes a cost of a 5-month advertising campaign, 22,000, which will end on 31st March 2024. So this advertising campaign will be for the months of November, December, January, February, and March. And remember, our year end is at 31st December 2023. It means that we should not be including these expenses for the next year. So we just need to remove the expenses for these 3 months. We know that for 5 months, the advertising campaign would cost 22,000. It means that for the 3 months, it will cost 22,000 divided by 5 times 3. Which results in 13,200. Now we need to remove this 13,200 from the distribution cost, as these are the expenses for the next year. So minus 13,200. Then debenture interest is outstanding at 31st December 2023. The debentures had been issued in 2021. It means that for this year, we use the debenture for the entire year. Let's calculate the total interest on debenture. That will be the debenture amount of 300,000 times the rate of 6%. This will give the debenture interest of 18,000. And we have been given the debenture interest that was paid. Out of 18,000, only 9,000 was paid, and the remaining 9,000 will act as the outstanding debenture interest. So it will be part of our liability. Then we have the tax for the year ended on 31st December 2023 is estimated to be 11,300. And on 1st March 2023, property was revalued at 720,000. Previously, property was 840,000. Clearly, there has been a revaluation downwards. Let's calculate it. So revaluation downwards is the difference. So 840,000 minus 720,000. That will be 120,000. And this should be subtracted from the revaluation reserve. It's given right here. But the revaluation reserve only has the amount of 90,000. It means that only 90,000 can be subtracted from this one. So the revaluation reserve at the year end will be 0. And remember, we had a total revaluation downwards of 120,000, out of which 90,000 is subtracted from the revaluation reserve. Now the remaining 30,000 will have to be subtracted from the retained earnings. Okay. Then on 1st May 2023, a rights issue of shares was made. Shareholders were offered 3 ordinary shares for every 5 ordinary shares held at 1st January 2023. So the basis in this case is for every 5 ordinary shares, we will be providing 3 new rights shares. So the first thing we need to do is calculate the number of ordinary shares at the date of 1st January 2023. It's right here. We have the total value and we have the nominal rate. So the number of ordinary shares is just going to be the total value 900,000 divided by the nominal rate of 0.5, which results in the number of ordinary shares to be 1,800,000. Okay, now for 1,800,000 ordinary shares, we will be providing 3 by 5 times 1,800,000 right shares. So the total number of right shares that will be issued will be 1,080,000 right shares. Now let us also calculate the values. Our ordinary share capital will increase by the nominal rate. So that will be the number of right shares times the nominal rate of 0.5. This results in the value of 540,000. Then it will also increase the share premium because we are told the shares were issued at a premium of 0.20 per share. That will be the number of right shares times 0.2. This results in the value of 216,000. And both of these should be added to the share capital and the share premium. Let's do that. So share capital will increase by 540,000 and the share premium will increase by 216,000. Okay. Then the trade payables total 38,000 on 31st December 2023. That is all for the information. Let's move towards the question. We need to prepare the statement of profit or loss for the year ended 31st December 2023. We need to start the statement with the revised figure for the gross profit from part B. And we need to use the space provided on page 5 to show the workings. In this case, I have already showed all of my workings right here on the question paper itself, but make sure that you guys show all of these workings in its designated place so that you get your markings correctly. Let's take a look at our gross profit amount. That was 346,200. Now we do not have any additional income in this case, so we can just move towards the expenses. And for the expenses as well, we've already categorized it into administrative expenses and distribution costs. Okay. Let us calculate the correct figure. For administrative expenses, that will be 111,400 plus 21,000, which results in 132,400. And for distribution costs, that will be 97,100 plus 14,000 minus 13,200, which results in the value of 97,900. Let's write these two values. So for administrative expenses, that was 132,400. For distribution costs, that was 97,900. Now, after subtracting these two, we can get our profit from operation. That will be 346,200 minus 132,400 minus 97,900, which results in 115,900. After profit from operations, we always have to subtract the finance cost, and the finance cost is basically the interest charged on our non-current liabilities. In this case, we only have the debenture as our non-current liabilities, and we've already calculated the interest for the year to be 18,000. Let's subtract this amount. Now we will get the profit before tax, because in this case we have been given the tax amount as well. That will be 115,900 minus 18,000, which results in 97,900. Now we will subtract the tax amount. which was given above to be 11,300. Now, finally, we will get our profit for the year. That will be 97,900 minus 11,300, which results in 86,600. That is all for the third part. Let's move towards the next one. And make sure you show all of your workings within this particular box in order to get your markings correctly. Now we need to prepare an extract from the statement of financial position at 31st December 2023 to show the equity and liabilities section only. Okay, let's start with the equity section. For equity, we have the ordinary share capital, then we have the share premium. We were given the revaluation reserve as well, but due to the revaluation downwards at the closing date, there will be no revaluation reserve. So there will only be the retained earnings. Let us first calculate the correct values for the ordinary share capital and share premium. We've already included the amount, we just need to calculate the total. For the share capital, that will be 900,000 plus 540,000, which results in 1,440,000. And for the share premium, that will be 55,000 plus 216,000, which results in the value of 271,000. Let's write it down. So ordinary share capital is 1,440,000 and share premium is 271,000. For the retained earnings, we've already adjusted the revaluation downwards, but we also need to add the profit for the year. So let us add 86,600. That will be plus 86,600. Okay, I think that should be all. If there is a dividend, we also need to subtract the dividends. It's right here. Dividends paid during the year was 45,000. So we also need to subtract the 45,000. Now the correct value for retained earnings will be 132,000 minus 30,000 plus 86,600 minus 45,000, which results in the value of 143,600. Let's write it down. 143,600. That is all for our equity. Now we can calculate the total equity. That will be 1,440,000 plus 271,000 plus 143,600, which results in 1,854,600. Now we can move towards the liabilities. And in this case, we have the debenture as well. But the debenture is to be repaid in the year 2024, which is next year. So we cannot classify this as non-current liabilities since we have to pay it within the period of 1 year now. This will also be part of our current liabilities. So we do not have any non-current liabilities at the end of the year. So let's write down the section for current liabilities. We can start with the debenture amount. So 6% debenture, which is to be repaid in the year 2024, and the total amount for the debenture was 300,000. Nextly, we do not pay tax immediately, so we also need to create a provision for the tax payables with the amount of 11,300. Let's write it down. That will be our tax, or we can write down as tax payable with the amount of 11,300. Then we have trade payables. Let's take a look above. I think it was given at the end of the year. Right here, it's 38,000. And in this case, we have other payables as well, because remember, for the debenture interest, we had the total interest of 18,000. But out of that 18,000, only 9,000 was paid right here. The remaining 9,000 will act as the other payables now. So we have 9,000 right here. And that should be all for the liabilities. So let's calculate the total liabilities. That will be 300,000 plus 11,300 plus 38,000 plus 9,000, which results in 358,300. Now, lastly, we will calculate the total equity and liabilities. That will be 1,854,600 plus 358,300, which results in 2,212,900. That is all for this part. And we have been given the working section. So you need to show all of your workings for the ordinary share capital, share premium, retained earnings, as well as other payables right here in order to get your markings correctly. Let's take a look at the next part. We have been given additional information. The directors are planning to expand the business in 2024. The expansion will be financed by one of the following options. Option A is to issue 8% debenture, which will be repaid in the year 2030. Option B is to make a general issue of ordinary shares. We need to advise the directors which option they should choose by justifying our choice, and we need to discuss both the options. Okay. This is of 7 marks, so 1 mark will be reserved for our decision. 3 points will be for option A, 3 points will be for option B. And in this case, I think it would be better if we write down by comparing the points. So the first factor is security. Option A will definitely require security because it is a debenture. Whereas option 2 is to issue ordinary shares and it will not require any sort of security. So whereas option B will not require any security. The second thing we can write down is that debenture will have to be repaid, whereas ordinary share is a permanent capital. So debenture will have to be repaid, whereas ordinary share is a permanent capital. Then the third thing we can write down is that debenture holders will not get any voting rights, whereas ordinary shareholders will get voting rights, which will lead to dilution of ownership. So debenture holders will not get voting rights, whereas ordinary shareholders will get voting rights, causing dilution of ownership. Okay. Then for the fourth one, we can say that debenture will require fixed interest each year, whereas dividends payment are discretionary. So debenture requires fixed interest charge, whereas dividend payments are discretionary. So dividend will only have to be paid when the company is making profit. There is no obligation to pay dividend when the company is making a loss. Then the next thing we can say is that interest payments will reduce profit, whereas dividend payments will have no effect on profits. So interest payment will reduce profits, whereas dividend payments will have no effect on profit. Now, based on these factors, we can make a final decision. In this case, I would suggest the directors to go with option A in order to avoid any dilution of ownership. Let's write it down. The directors should choose option A in order to avoid dilution of ownership. Alright, That is all for this question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure you're subscribed to this channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.